When you talk to a real estate bull, or if you listen to the mainstream financial media, they will tell you how resilient the real estate market has been in the face of the most aggressive rate hikes in the history. But they forget the historic facts that when the real estate market crashes, it's not a single year event, it's a multi-year event. So when we look at the historic crashes like 2008 in the US or in 1990s in Canada, we saw the market crashes across the period of multiple years. Okay, so when the crash happened in 2008 or in 1990s, it was a big chunk of price reduction in first year, but then there was a subsequent price reduction over many years, and it took them 6 or 7 years sometimes before it hits the bottom, before it starts going up. So the crash is not something you happen to see in year one and then from year two starts going up. It actually happens across the multiple years. So visual capitalists, they put together a very good chart I'm going to share with you, and they analyze major real estate markets, and they understand their household income, their population, the interest rate, the rental market, as well as the geopolitical impacts. And they put together an index, and according to that, if the market has an index value above 1.5, considered a bubble risk. If it's below 1.5 and higher than 0.5, it's overvalued, and it is anything below 4.5 is considered fair value. Now, the key thing here is that they also did similar study last year, and last year they had 9 cities in the bubble risk in 2022. But out of those 9 cities, 7 of them actually came out of that bubble risk and now falling under overvalued category. And the reason is we saw a massive rate hiking cycle that has popped the real estate bubble of those 7 cities, and now they are falling into the next category of overvalued pricing. Now, if you look at this chart, you can see that especially Toronto and Vancouver, and these prices are inflation adjusted. So we are seeing Toronto has seen a almost 15% price reduction, inflation adjusted. Vancouver 10%, almost 11% price reduction. So Stockholm, look at that, 22%. Like, this is just 1 year, guys. 1 year price reduction, double digit. And if we look at the history, we saw the previous 2 crashes in the US or in Canada. We saw it was never a 1 year event. What we have seen right now after a year, do you think it's going to stop here, or is it going to continue? Provided if the rates stay at this current elevated level, because I think they are now at a point where they're not going to increase the rates further, but that doesn't mean that they will start cutting rates. So if the rates stay at this level, if we see the economic conditions getting more tighter, if we see the macroeconomic factors are going to play its role from a global crisis perspective, and the other geopolitical situations forming up elsewhere, do you think this is going to stay here, or this is going to continue getting deteriorated? My take is, if things stay at this level, we will see further price reduction going forward in the years to come. But hey, this is just me speculating based upon some of the historical patterns. But the point here is, when we look at Dubai, that is an outlier, 14.6% price growth this year alone. So, and if you look at why this happened, is because the oil prices have gone up. So that has contributed a lot of economic growth in this tiny city in the Middle East. But there's also a lot of immigration influx into this country from Russia, from Ukraine, from the other countries, wealthy individuals who are bringing money into these markets to prop up the real estate market. So when you see these kind of events, you have to question yourself, is this a one-time event, or this is going to be sustainable event going forward? What happened in Dubai in the last year, it may not sustain over the long run. Okay, so when you invest into a market, you have to question yourself, am I getting bought into a hype, or I'm really looking into some fundamentals? So some average investor will look at this chart and say, okay, 14.6% growth in 1 year, maybe this will continue, and I'm going to spend my money and buy a real estate property in Dubai, right? So you have to understand, okay, what are the dynamics in the local economy? Are local income affordable to purchase a property? If it is taking 10 times your annual income to buy an average property, definitely it's a red flag, and this is not going to sustain in the long run. This was the case in Toronto and Vancouver, and now we are seeing that bubble is being popped by the aggressive rate hikes. Now we look at the rental market. They also have built up a very nice chart about the rental market as well. And one thing we see that even though the real estate market crashed from a pricing perspective in Toronto and Vancouver, but the rental market has gone even crazier. And the reason is population growth. We saw million plus people came in last year. The similar amount of people will come this year as well. And the federal government is not stepping back. This will continue inflate the rental prices going forward. And same thing happened in Dubai. 20% sorry, rental price growth in the city because of the immigration from Russia, Ukraine, and now from the other Middle East countries if the war escalate. So these are the things that could drive the real estate prices very, very quickly because of these external affairs. And these are mostly temporary events that is not going to sustain in the long run. So when you are interested in terms of investing into real estate in other countries, consider these effects. Okay, this may not going to sustain in the long run. So you might be buying into a hype which may suffer you a loss going forward if those events change its direction. So this is exactly what I'm thinking about it. I don't think the real estate market in Canada is going to revive anytime soon until the financial conditions change, which require rates reduction and monetary cycles to ease up. But this will have a drastic impact on the economy overall, especially the Canadian dollar. We're seeing the Canadian dollar is losing its power against the mighty US dollar because the differential between US and Canada interest rate is going to widen up. This will put more pressure on Canadian dollar, and this will continue to crush it. And as we see the Canadian dollar gets weaker and weaker, our imports become expensive. Okay, so we import a lot of food in this country, and the import will become expensive, which will continue to push food pricing up going forward. Anyway, these are just my thoughts sharing with you. If you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. Thank you.